Mike, we have been talking about this value growth premium divergence for quite some time, and it continues to set records and sort of go against conventional wisdom as to why value has underperformed growth so much. So we've got this chart up. Let's just talk more in detail about what this is, what this means, help the viewers understand how big of an event this really is.
Yeah, basically what this chart lays out is the performance of cheap stocks, value stocks, versus growth stocks since 1926. And this data is provided by Eugene Fama and Kenneth French. And it shows a few things. One is this is long-term performance. So think of this line as a collection of dots. Each dot represents the performance of value versus growth over the prior 10 years. So the first thing you notice is value pretty consistently outperforms growth throughout history. Buying cheap stocks with a margin of safety and hoping that they get more expensive or they start to grow their earnings or whatever the case may be, that's been a very historically reliable investment strategy. There have only been a couple instances where it hasn't worked. The most significant prior to this instance was the tech bubble, the very peak of the tech bubble. So you'll see that stick out in the year 2000. And then you see what's going on now. Unprecedented value having their worst performance relative to growth stocks ever by a significant margin, underperforming growth stocks by 6% annualized the past 10 years. So 6% every year for the past 10 years.
Wow.
So it's gotten extreme.
Yeah, and so we'll dig into this a little more, but like, what does that portend if this does revert? Like, what kind of outperformance would you expect here?
Well, you use history and look at some analogs. The only thing you can really compare this to is the height of the tech bubble, and understand that this is larger than that. So what happened during the tech bubble? Well, at the very height of the tech bubble, when the trend reversed, you think back to what the catalyst was. And we went into recession. There was Microsoft, who was one of the bellwethers back then, lost an antitrust lawsuit, and the rotation started. And a lot of these companies, these growth companies, they had these huge lofty expectations for growth that everybody all of a sudden realized that they could never actually meet those expectations. And then the rotation started and it just fed on itself. So what happened was after the tech bubble burst, value stocks outperformed growth stocks by over 60%, 60, in 12 months. So huge. Right. And then they went on to consistently outperform growth stocks for the next 4 to 6 years. So if you use that as an analog and you think this time would be bigger if there was a snapback, then your bull case scenario for value stocks is, once this reverses, maybe over the next 12 months, value outperforms growth by 100% or more.
Right.
That's totally within the realm of possibilities.
Right. But people would look at this and say, is this time different? Will this continue or persist? And it's hard to answer. Like, you could call this is a widowmaker trade for value managers, right?
Yeah, definitely. And it's very difficult to say. There are always compelling arguments why this time is different. Those compelling arguments were there during the tech bubble. They were there during the Nifty 50. They're always there. So you take sort of a different approach to looking at this and just say, how much longer can this continue? Because when is it to the point where, all right, these value stocks have underperformed so much, they're so cheap, and these growth stocks are so expensive and have rallied so hard that let's start with a baseline of they just stop underperforming. So your downside is limited. And that in our view is all you need to get really excited about this trade.
Right. Yeah.
Just think all the risk is to the upside at this point. And we have to be approaching that point. We have to be. And then you can start to think of what are catalysts for reversal, keeping in mind that you actually don't even need any catalysts. These things can reverse for no reason at all. But it would be nice to have some catalysts coming up that you could hang your hat on to get even more excited about taking the value side of this trade.
Yeah. And maybe like in thinking through some of those catalysts, like what would be like the election could be a catalyst, a change in leadership could be a catalyst. Like there's a lot of these catalysts out here. Are there any, can we handicap any of them that we think would have a higher probability of sort of sparking this reversal?
Yeah, so you could think about the virus situation. So stay at home, looking at your screen, and the perception that we're going to be doing that for the rest of our lives. Maybe that's a bit overblown. But if that reverses, that could be a catalyst. So how would that reverse? A vaccine. We're very productive news on vaccines. What we find is interesting is the vaccine stocks are at all-time highs. And they're pricing in that we're going to get multiple vaccines approved for emergency use, emergency authorization by year end, and potentially 6 more in early 2021. So those stocks are at all-time highs. The market really believes in them. But at the same time, all these work from home forever stocks are at all-time highs, and all these lofty growth stocks are at all-time highs. And both of those can't be right. So there's a potential catalyst there. Who's right? Science or everyone's perception of these work from home stocks achieving these extremely lofty revenue goals for the rest of time. So there's a catalyst. Change in leadership, definitely a catalyst. If you see a blue sweep, the idea is you're going to see fiscal stimulus and fiscal spending be a much larger portion of the overall economic stimulus mix than we saw previously. We know that these types of stocks react favorable to improving economic growth, especially a cyclical type of a recovery, a recovery in oil prices, industrial companies, materials, things like that. Those are all value names. So if we got a big fiscal impulse at the time that the economy was naturally recovering as the COVID situation gets better, that could be a catalyst. That would probably be temporary. And then things like tax policy could definitely be a catalyst. One of the biggest reversals we've seen was in 2018. I'm sorry, it was August of last year, actually, when Trump sent out a tweet about a potential change to the capital gains tax rates. And we saw a huge reversal in momentum stocks and value stocks outperform. So that we could really dig into how you would play this from a capital gains perspective. It could go either way. It's quite a bit of interesting game theory. But you could see how if the perception is that capital gains tax rates are going to increase, and I'm sitting on a huge unrealized gains in these growth stocks that have done so well.
Right.
And I'm looking at this trend, do I want to sell now, pay less tax, as opposed to waiting, deferring, and then eventually having to pay higher tax later?
Yeah, it's going to be interesting to see. And we're for the viewers, we're going to do some research on this idea of what happens when there's big changes in the capital gains tax rates, because we think that this could be a very big catalyst to initiate that rotation to happen. However, I think as we look at it, it's going to be very difficult for the blue, if there is a blue sweep, for them to raise the capital gains tax rate to what's been proposed under the Biden plan, because that would just, I don't think there would be good consensus even among Democrats to go that far with it. So, and I think we've seen some data that others would agree with that suggestion, that perhaps we'll see something less than that. Even on the corporate income tax side, see something less than the 28% move. But just looking at this chart, though, what's interesting is people think the market's at all-time highs, but this would suggest that there's significant opportunity within the market to look at sectors of the market that might be of good value right now going forward.
Yeah, definitely. And you can see that a lot. That's probably more pronounced if you look at the next slide, where we really highlight some of the most unloved areas of the market. Right. So this chart, so it hasn't just been a growth versus value thing, it's been a mega cap thing. So mega cap growth companies have done so well. The larger, the more expensive, the better. And I don't care if you have earnings. That's been the trading strategy, right? So
so just before you get into here, just explain what a small value company is and give some examples of like those types of companies.
Yeah, small value companies, so small in terms of market cap. So it doesn't necessarily have to be like a new startup company. They can be experienced companies you may have heard of that just haven't raised a lot of equity capital. They haven't felt like they need to, so they don't have a big market cap in terms of equity. And then value, generally cheap from a price to book perspective. Sort of when people think of small value now, right now, because the makeup of what is value and what is small changes over time, right, based on the market environment. But as we think about it now, it's a lot of small and mid-sized banks in particular. They soak up a huge chunk of the small value benchmark. So think of any of your regional banks that are small and mid-sized, not like the big ones like JP Morgan or Citibank, obviously. Any of those small regional banks, odds are they're in the Russell 2000 Value Index. And so what we're looking at here, so a similar type of analysis. Now we're looking at the performance of small value stocks versus large growth stocks. And this line, once again, is a sequence of dots, but each dot is a 1-year look back. So just a shorter time period. And you can see, like, not only has this been the worst 10-year time period for value versus growth stocks, but in the past 1 year, small value has underperformed large growth by 50%. 50. That is, for those of you who are really into statistics, that's a 3 to 4 standard deviation event, meaning it should theoretically almost never happen. And it's happened. The only other time it happened was in 2000.
Right.
At the height of the tech bubble, once again. So to the point where the market is at all-time highs. The S&P 500 is near all-time highs, yes. But if you want to go bargain hunting, there are plenty of opportunities for you. Plenty of opportunities. And when the tech bubble burst, small value stocks outperformed large growth stocks by over 70%.
Yeah, I mean, just look at that reversal back during the tech bubble. It's incredible how fast it happened and the magnitude of it. And we've seen a lot of return chasing right now as money has moved out of virtually every asset class into large growth over the last 2+ years. And so there's a lot of asset classes that look like this.
Yeah, definitely. And the other thing to keep in mind is, this is a very volatile chart, but if you were to average these 1-year periods, small value on average does outperform large growth by about 2% per year.
Yeah.
The key is look at how volatile it is. So
yes.
you have to be there because it reverses so quick. You can't chase it. Once it starts, it's going to be so vicious. It's going to be so fast. And then there's a potential where if you're not in it now, you're probably going to be late once it happens.
Right. And it's always important to consider your time horizon with these things as well. If you have a long time horizon, it's worth looking at some of these asset classes to invest in now.
Yep.
So let's move on to Aud. If you can pull up the next chart here. And just for the viewers, Audra is the person who works all these miracles behind the scenes and produces all these great videos. So we want to thank her for all her efforts here. And many listeners have asked for us to call her out. So one day we'll get you on camera. This is a great chart in terms of what we've seen here in the last year, especially in the last few months, have really sort of driven that bump up we had to all-time highs just a few weeks ago. So let's talk about this chart in particular and what it means.
Yeah, and narrowing our focus here, not only talking about how over the past 10 years these mega cap growth stocks have done so well, but also pointing to now the types of money that's coming in to some of these mega cap growth stocks, given how expensive they are. It's increasingly speculative in nature. And so the market structure becomes more and more unstable. And so what we're specifically looking at here, these are call options in the darker line, and then put option volumes in the lighter line. So just the volume of call and put options traded on for US equities and indexes on multiple exchanges and aggregating it. This is a 30-day moving average. So what you'll see is more people are participating in options trading than ever before. There are more trades placed.
Robinhood, thank you.
Yeah, exactly. And to that point, you think of an option, it's a very risky security. It's very complicated. A lot of people don't understand it, or at least it appears that way. But the over half of the option trading volume is now driven by retail. It's actually not driven by institutional investors. So how this happens? Typically, when you buy a call option, it doesn't have to affect the actual stock price. It's two different things. A call option is a derivative. You don't actually have to buy the stock. Because what normally happens is somebody goes out to their Robinhood account and they say, I want to buy a call option on Apple. And then Robinhood, or whatever options exchange Robinhood is working with, the market maker there says, okay, well, I have somebody on the other side of the trade that's going to sell you that call option, and done. And that's the end of the trade. The stock price is never touched in that situation, and options can trade independently of movements in the stock all they want. But what's broken down is there is a massive shortage of options sellers, particularly call option sellers right now. Why would you want to be selling call options on Tesla when they go up 10% a week? That's a fool's errand, right? So now what you have, you get that same order. Hey, I want to buy that call option on Apple or Tesla or whoever. The market maker goes out and they just hear crickets. Nobody's willing to sell that option. Nobody's going to take the other side of that trade. So the market maker has to make a market. So they'll sell you the call option, but they're a market maker. They don't want to take a position, an outright position in that option. So they can't just sell it without hedging it. And how do you hedge it? You hedge it by buying the stock. So the more and more call option volume you have,
feeds on itself.
Exactly. With the instability of the market structure, the market makers, in order to hedge their risk here, they're buying the same stock and bidding up the price. And so it magnifies the up moves, but it also magnifies the down moves.
And there was a lot of, I don't know if rumor or fact, about big players like SoftBank and JP Morgan in the option market buying up options during that run up.
Yep. Yeah, there's definitely a lot of that. So yeah, it wasn't just retail traders. It was big sophisticated institutions doing it as well. And, you know, a lot of institutions are doing it as, hey, I'm going to sell my position in Apple because I don't want to own the stock anymore. I'll just participate through the options market. So, you know, it's tough to say exactly what the positioning is, but what we do know for sure is unprecedented volume, lack of call sellers, market makers are magnifying the moves in these stocks upwards and down.
Right. So talk about a catalyst for a turnaround value to growth. What happens when this reverses?
Yeah. So if there's some type of an actual fundamental catalyst that is bad for growth, say you get antitrust lawsuits against some of these MAGA F names, which is totally a catalyst potential through the end of the year. And you'd say, okay, well, based on my understanding of the company's earnings and fundamentals, this antitrust lawsuit, I think the stock should go down 10%. The instability of this market structure through what market makers are having to do here, just know it's going to go down twice or three times that much. And it's going to be very fast. That's all this does. On the same side, on the other end of the coin, it's if that doesn't happen, or if there's a positive fundamental catalyst and you think, oh, the stock should go up 2%, it's probably going to go up 4 or 8, 16, so on and so forth. So it works in both directions.
Yeah. Yeah, it's interesting. And it's the divergence here is quite significant relative to other time periods of in recent history.
Definitely.
All right, so let's move on to the next slide for discussion here, which was also really interesting size-wise and sharpness, as we saw this in the recent data about a lot of hedge funds going short on the NASDAQ, obviously protecting their gains to some degree. So why did we see this quick short move by hedge funds?
Yeah, it's tough to know the exact reason why, but some of the well, first off, what the chart is showing is that net hedge funds or anyone who's participating in trading non-commercial futures on the NASDAQ E-mini 100, which is very sophisticated investors and usually hedge funds, they went net short in a big way in September. And so a few potential reasons for that. One, they know that these stocks have run up so much and they understand the market structure and they know it's been driven by options volume. And so they're just trying to protect themselves. So they've hedged the positions, or they actually think the NASDAQ is going to go down. Crazy to even fathom, right? And so they want to make money off of that. So they're going short in that way as well. But no matter what the underlying rationale is, you have to note that this is the biggest net short position these very sophisticated and well-informed, sometimes too informed, investors have made, in the history of the data. So you have a lot of smart people betting that this can't go on forever.
It's a great illustration of the point that we like to discuss a lot, where it really isn't about the market. It's about the other investors in the market. And that's who you have to be sort of always watching, because the stock prices are the stock prices. It's everyone else's behavior that's really the telltale sign of where things are heading. So we just started looking deeper at some balance sheets, and really were surprised at the level of divergence inside some of these tangible book ratios within the S&P 500. So this might be a little bit in the weeds here, but I think it's worth us discussing why we've seen this big divergence. It's not really unexpected given what's gone on over the last 5 to 8 years since the great financial crisis, but take us through what we're looking at here.
Yeah, so a classic value strategy is I'm going to buy a stock that looks cheap relative to its book value.
Right.
And the idea of book value is, if I were to liquidate this company and buy back everything on their balance sheet, how much would it cost me? That's a high level idea of book value.
Right.
So it's a very traditional way of valuing stocks that's worked for a long time. A lot of value investors is a big part of their process. And so what you see, if you just look at the S&P price to book ratio for the S&P 500, the dark blue line, I mean, it's expensive, but we know the market's expensive. So it's in about the 85th percentile of expensiveness. So not alarmingly expensive. But what has happened has been increasingly the book value of the largest companies in the US, more and more of it is intangible assets. So think of goodwill, how much you basically are admitting you overpaid for an acquisition, or other intangibles like patents, social networks, things like that. How do you value Facebook's network?
Right.
Very difficult to say. And asset-light businesses have been in vogue. If you come up with a business model where you can drive a lot of revenue, but you don't have any brick and mortar, you don't have any, tangible assets on your balance sheet, that's a great company to own. So what's happened now is, if you look at the price of the S&P 500 relative to tangible book value, it is the most expensive it's been by far. Not even close. So in the 100th percentile of expensiveness, far more expensive than it was in 2000 during the tech bubble, which was viewed as, the biggest insanity ever seen in the stock market was the tech bubble. So putting that into perspective, increasingly, 70% of S&P 500 book value is intangible now. And we're talking about the 500 largest companies in the US. There are about 200 of them now have negative tangible net worth. Meaning, if you were to subtract out their intangible assets, they would be out of business. Their balance sheet would no longer balance. And that's also a record.
And did we, I don't know, maybe if we haven't yet, maybe we definitely should be. I know you and I looked at this at different companies in different sectors, but is there any one particular sector that really is drawing this higher?
Yeah, a lot of software as a service. That entire business model is very tangible asset light, intangible asset heavy. And then think of any large growth company that has grown through acquisition. They're going to have huge goodwill on their balance sheet. And, we say this because it's just a sign of the times a little bit. It's not necessarily worrisome, except for the fact that, hey, it's another thing showing the stock market is expensive, particularly these growth names. But also just understanding the nature of those assets. They're very difficult to value, and they're subject to impairment tests. Mm-hmm. And when it's viewed by an auditor that these intangible assets are impaired, they typically don't mark them down 2%. They typically mark them down a lot, and companies have to take big impairment charges. And that can be a significant catalyst for a reversal in the stock price. Mm-hmm. So it's more like an elevator as opposed to an escalator type of a situation with how these assets are valued and what they mean.
Yeah, it's one of the things we look at in depth on the companies that we have in the portfolios that we manage, and it's scary to see some of these values for some of the companies in the S&P 500 and how they could just disappear quickly.